Iman Brivanlou is the Managing Director of Income Equities at TCW and joins us now for today's Hot Picks. We're talking about dividend stocks, which is always popular with our viewers at BNN Bloomberg. I want to talk about what your threshold is for an attractive dividend yield right now, given what we're seeing in the bond market. You can finally get yield there. Does that affect, what qualifies as an enticing equity on the dividend front?
Yeah, absolutely. So thank you for having me. We definitely do see very attractive opportunities in income equities right now. We think they present an attractive risk-reward profile. From a relative standpoint, you mentioned bonds. Dividend stocks can offer a pretty compelling combination of upside capture, in case or for when the economy eventually recovers, as well as downside support, because of the high dividend. So we think from that combination can be compelling for investors right now. Okay,
so let's take a look at some of the names that you think offer good exposure. Ares Capital, which is an asset manager, it's actually done very well as a stock. The yield is pretty eye-popping, close to 10%. When you get to those levels, you ask questions about sustainability.
Yeah, you make a very good point. Typically when you dividends, that may be a warning sign. Certainly 10%, as you mentioned, is eye-popping. The market may be telling you that the dividend yields are unsustainable, and in fact, historically, those very high dividend payers tend to underperform. But we think with Ares, it's a pretty special case. It's different. So first off, Ares is a BDC, a business development company. And what BDCs do is they are essentially the lenders to the U.S. middle market segment. So middle market companies tend to be companies that are too small to issue bonds on their own, typically revenues ranging from 10 million to $1 billion. They have real financing needs. And since the global financial crisis, their typical sources of capital, which used to be regional banks, have essentially stepped away from middle market lending because the capital charges are too high. And so the BDCs have had to step in and they provide financing, and the financing is done on pretty favorable terms as long as the underwriting platform is robust. So in other words, as long as the loans don't carry huge risk on them. And Ares is a company that has an incredible track record. Even during the financial crisis, their net accruals, which are essentially their troubled loans, peaked at 4%. And net realized losses were only about 2%. So it's a culture of strong underwriting, a disciplined approach to lending that I think in the long run is going to pay off for investors. Currently trading at 1x book value is a pretty good entry. So we have very high hopes for double-digit one-year returns on that stock.
I don't have many guests often coming on advocating office exposure in real estate, but that's your second pick, Alexandria Real Estate Equities. Is 3.5% enough of a yield to compensate for some of the risks that they might have in office?
It's an excellent question. We think it's miscategorized as an office REIT. So it's actually the owner of predominantly Class A lab space. It's a life sciences play, if you will. So its advantages stem mainly from network effects. The properties that we're talking about, think of biotech lab space, tend to be in very high demand locations, supply-constrained tech hubs near major universities. So for example, you can think of Kendall Square in Cambridge, Massachusetts, close to MIT, close to Harvard, Palo Alto, close to Stanford, La Jolla, et cetera. So this type of space for startup biotechs is essentially mission critical. They need to be clustered near campuses in order to attract talent. So we view, Alexandria as being fairly immunized, from the type of broader overhang that is experienced in the office space. They have an about 80% retention rate, and most importantly, they have pricing power. So we think that they can grow their FFOs and multiples, over time by about 10% per year. That's been in line with the historical average. Current valuation at an implied cap rate of about 6%, we think doesn't properly reward the company for its stability and visibility of cash flows.
Lastly, you have M&T Bank, which is a regional. Again, it's offering a yield that is below than what you can get right now on a U.S. 10-year. Do you get very fussed about that sort of thing? Are you happy with anything north of 3% these days? How do you think about that?
It's you have to develop a balance when you invest in income equities. You don't want to have too many of those, 8, 9, 10% payers, you're going to, eventually blow up in one. We think the more compelling value proposition is in those kind of 3 to 5% range. MTB is a perfect example. A very well capitalized regional bank. The sector is typically viewed as being highly cyclical, but we think investors are essentially waging the last war in terms of where they look for risks. Since the global financial crisis, I would say that the banking sector is actually pretty well capitalized as conservatively as it has been in decades. So M&T in particular, the ticker is MTB, we think has certain pretty compelling competitive advantages. Its lower average deposit size makes the deposit space a little bit more sticky at a time when interest rates are going up and depositors are asking for more yield. It has lower duration assets, which we think is going to allow it to roll into higher yielding assets. And it's got, more importantly, critical mass and scale. It's a dominant player in the Northeast in its regional markets, so places like Buffalo, Baltimore. It has the requisite scale to compete effectively in order to stay, essentially competitive. So, it can make the technological investments that are needed to stay relevant, like online, mobile customer experience, and so on. So,
Iman, I only have 20 seconds, so I just want to ask: is energy part of your income investing strategy these days?
Yes, we also invest in energy. We favor the kind of weapon suppliers, if you will, the pipeline type of companies. We don't really love exploration risk, but companies like KMI, I think would be an interesting place for investors to look.
All right.